Looking to navigate market highs and maintain a balanced portfolio? In this video, we'll break down how systematic transfer plans or STPs can help you manage risk, maintain asset allocation, and adjust your investments. A systematic transfer plan or STP is an effective way to transfer investments from one mutual fund scheme to another mutual fund scheme within the same fund house. Whether you're moving from equity to hybrid funds to reduce risk or from liquid funds to equity to capture growth opportunities, STP provides a flexible and disciplined way to navigate market volatility. With an STP, you can set up regular transfers of a fixed amount from one scheme to another. This approach allows you to benefit from market timing by gradually moving your investments, which can help reduce the impact of volatility. An STP helps you stay disciplined and stick to a steady investment or transfer strategy. It's particularly beneficial in volatile markets, allowing you to systematically enter or exit investments without making a lump sum shift. When markets are at an all-time high, you might feel hesitant to invest a large amount in equities. Here's where STP comes in. You can invest a lump sum in a liquid scheme and set up an STP to gradually transfer funds to an equity scheme. This way you enter the market gradually, lowering the risk of investing all your money at a market peak. Example, an STP from a liquid scheme to a pure equity scheme. Let's say, for example, you have rupees 10 lakhs to invest. Rather than investing it all at once, you park it in a liquid scheme and set up a monthly STP of rupees 50,000 to an equity scheme. This approach allows you to take advantage of rupee cost averaging, buying more units when prices are low and fewer units when prices are high, thus balancing the entry point risks. When nearing retirement, the goal shifts to preserving capital while ensuring steady income. At this stage, it's wise to move funds from high-risk equity schemes to more conservative investments like hybrid schemes, which have a balance of equity and debt. An STP allows you to systematically reduce exposure to equities, giving your portfolio time to adjust to a more conservative asset allocation as you approach retirement. For example, Mr. Sharma, who is 5 years from retirement, would set up an STP to transfer from a pure equity scheme to a conservative hybrid scheme. This strategy allows him to reduce risk gradually, preserving his retirement corpus as he nears retirement. An STP helps you stick to asset allocation by enabling systematic, gradual rebalancing between asset classes. Whether you need to shift funds into equities or dial down risk with conservative schemes, STP makes it easier to adapt your portfolio over time, making sure it aligns with your long-term goals and risk tolerance. For example, during market volatility, an STP allows you to transfer funds from debt to equity or vice versa, keeping your portfolio balanced without large, abrupt changes that could impact your returns. Here's another example. You can transfer from one scheme to multiple schemes within the same fund house. For example, equity, hybrid, and sector-specific schemes. With an STP, you can transfer funds from a single source scheme to multiple destination schemes within the same fund house, of course. This strategy allows you to diversify your investments systematically across various schemes, creating a balanced portfolio without the need for multiple initial investments. Suppose you have parked a lump sum in a liquid scheme and you want to diversify into equity, hybrid, and international schemes. You can set up an STP to gradually allocate funds to each of these options, customizing your asset allocation within the same fund house. Starting an STP is simple. Number 1, log into your RTA or fund house's online portal. Number 2, choose the source scheme and the target scheme or schemes that you want to transfer to. Third, select the amount and the frequency of such transfers, such as monthly or quarterly. Number 4, confirm and set up your STP. You are now set to transfer systematically between schemes. STPs have tax implications depending on the type of schemes involved. Equity schemes. Gains while making transfers from equity schemes are subject to capital gains tax. If held for more than 12 months, long-term capital gains tax or LTCG applies at 12.5% on gains above 1.25 lakh. If held for less than 12 months, short-term capital gains or STCG applies, which is 20% on gains.
What about debt schemes? Gains while making transfers from debt schemes are taxed based on the respective investors' tax slab rates.
Here's an example. Let's say, for example, you're transferring rupees 1 lakh monthly from an equity scheme. Each transfer will trigger capital gain or loss based on the scheme's NAV, and the applicable tax will depend on holding period of the units being transferred. The FIFO or first in first out method applies, meaning that older units are sold first, and this potentially gives you a tax advantage if the older units qualify for LTCG. STP is a powerful tool for managing portfolio risk, maintaining asset allocation, and dealing with market highs and lows. Gradually transferring funds, you can achieve a disciplined approach to investing, avoid making hasty market moves, and ensure your portfolio is well positioned for the future. If this video helped you understand how STP works, give us a thumbs up and subscribe for more insights on effective investment strategies. See you in the next video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.